So this was a two-pronged capital increase.
Yeah, and this was the second leg of the capital raise. Importantly, shareholders agreed to buy 98.2% of the shares in this rights offer. By all accounts, that is a success. And the timing is notable because it comes a week after Credit Suisse's shares fell to a record low, which many will tell you made this capital raise pretty much on shaky ground. A rights issue, I should point out, is an offering of shares to existing investors that allows them to buy shares in proportion of their holding at a discounted price. This compensates them for the dilution that occurs in a capital raise. So bottom line, it was a big success. 98.2% of the shares sold to the shareholders. The rest will go on the open market now for sale. This second leg raises about 2.5 billion francs combined with the first leg, brings in about a total of 4 billion francs, or 4.3 billion US, all designed to fund a comprehensive restructuring of the troubled bank. Now, there was a private placement last month that included Saudi National Bank, which now becomes the largest shareholder, although with less than 10%.
What's the outlook then for the bank? Can it, now that we know that you can fund the turnaround plan?
The outlook a lot better than it was, and importantly, the wild ride in the stock viewed to be over. Let's just take a look at some of the reaction in Zurich. Shares were up better than 3%. In U.S., the American Depository Receipts, ADRs, were up at 1 point better than 5%, closing with an almost 5% gain. So Credit Suisse's CEO says the successful completion is a key milestone for what he now calls the new Credit Suisse. You take a look at just year-to-date performance of this stock. It really had been dismal. There were a lot of questions about the future of the bank. The CEO saying this now, the fundraise allows further support for the strategic priorities. The rights offer also strengthens its CET1 ratio. That's a key metric of financial strength. You look at the big picture for Credit Suisse in the last 2 years, it was an ugly picture. Billions in losses from two major fund catastrophes, Archegos and Greensill. There were additional scandals, client defections, asset outflows, and now at least the CEO and analysts seem to be confident that they've shored up the balance sheet and put to rest questions about the bank's financial future, and they can get to the business of restructuring and turning things around.